are breaking the first rule of margin management. So this gives you a way to see it. They are very accurate. Let's take a look at a chart here. A lot of them here, okay? All these blue lines are the T30s, okay? So let's just look at a couple of them and see if the market knows exactly where they are. You see where it stopped there? And you see up here where it almost made the T30, it just missed it by maybe 3 pips. That's it. Rocket straight back down. You notice right over here where it stopped? At the T30, okay? When it rockets back up again, you can see it pulls up, doesn't hit the T30, and pulls back and runs 3 times along the bottom of this T30. And then it rockets up. Notice that it stops at this one. Now remember, this is from here to here is 60 pips. All right, so it's not a little run here. All right, now we take a look over here. See when this run pulses again? Look how they know exactly where the T30 is. Keep going up the line, and you see right to the T30. And every time we pass one of these T30s, we move our stop, staying in these trades for the longer runs. You can see another one here. They knew exactly where that T30 was, and finally up at the top, they knew exactly where that T30 was. So you can see they're very accurate. However, remember, they are only interim targets. They are not the big boys' targets. Now, we also use the PAT projector. It's a tool we invented, and we know that the big boys move the market in 55+ pip movements. Okay? Why do they do that? It's because they live by the rules, and they cannot make puny trades like a retail trader. They have larger targets for proper risk to reward ratios. Okay? So, if you can find their pulse of money entering the market, then you can spot their interim targets. And guess what? We can. So we mark it 2 ways. All right? The white dot, or the arrow and painted candles on the wild card, or the arrow and painted candles on the wild card, 6 aces, and the royal flush. What you're seeing when you see the white dot show up, or the arrow and painted candles, is the pulse of money into the marketplace. So when harmony is present, that's when momentum enters the market. So our first entry of every session always has an initial target of 55 pips. None of this clicking out for 5 or 8 pip stuff. Alright, so let's take a look at one here. I've got the PAT projector up. It's just a little tool that shows up like this. You can see that where I enter, it's just going to give me a line on the chart. It tells me where a 35 pip stop would be against me and a 55 pip limit. I just need to see it on the charts. Okay, so I can see I'm in a downtrend, and I need to have permission to trade this chart. Well, the white dot tells me I have permission to trade this chart. Alright, that tells me the big boys are entering in the sell. Alright, so there's my first opportunity to take the trade after the white dot. That's when the money enters at my level. Alright, so right there is where it is. You see, we can find the point where they start. Alright, so when I click that, it's going to give me my stop up here and my limit at 55 pips. Okay, remember we started on this candle right here, so my job is to stay in to the limit, and the limit is 55 pips right there. You see that? We'll take this whole run down here, and I'll show you how each of these pulses does 55 pips. Alright, so I've got them marked on here, and we're going to start with this one. After that trade we just did, here's our next opportunity to trade here. So right there, if I take it down and click on the entry from there, I will get a limit down here. And you notice where the market went. A little past 55 pips. Alright, here's another one. There's the the dot entering the market again. The big boys have entered. Alright, and now I can measure it. There's the limit. There it goes. Here's another one right here. This is the starting place. The money pulsed in again. Where are we going? 55 pips. You can see that whole run there moved in 55 pip swaths. The key, however, is you got to be able to identify the starting place, and that's what we do. If you can identify the starting place for the big boys coming into the market, you can then plot their targets. Now the HSI tool is used to find bigger targets. Once we can find a top or a bottom, it will give us a starting point for the next leg of the movement. And we simply click on that starting point using the tool, and we tell it whether we're a buyer going up or a seller going down. The HSI tool will give us the supports and resistance based on that direction that are the targets. The HSI calculates the Fibonacci ratios and the historical supports and resistances instantly, and shows us where the big boys' targets really are. There is no tool like it on the market, because remember, it's combining two tools that you should use in technical analysis into one. Alright, so here's the bottom. We can see the bottom very clearly right there. So we use the HSI, it's this little tool right up here, and we click on that bottom of that wick. That's why these little yellow lines are here. So all you have to do is click on that yellow line that gives you the bottom, and we tell it we're a buyer. It tells it that that base is at 1.7734. That's the starting point. So once I click on that, it gives me the R1, the resistance 1, the second resistance, the third, the fourth, the fifth, all the way to the 10th resistance up. Alright? Now you can see in this movement we've already had movements up. Let's take a look and see if the big boys know where these targets are. You can see right here from the bottom to the R2 they knew exactly where it was. From the R2 to the R3 they knew exactly where it was. They ran along that for quite a while, and then when they finally broke they went right up to the R4 and then they pulled back. And now we're up here at the second R4. So what we now know is that if our potential next target is at the R5, we can simply count the T30s, 1, 2, 3, 4, 5, so we have a little more than 150 pips up to the next target. Shame on you if you know where that is for clicking out for 5 or 10 pips. Alright? So now we know that if we can break this resistance, a move to the potential target is the next step. Alright? So let's just see what happens. And you can see exactly what happened. Right up to the R5. Okay? No stopping in between here. Why? Because the target was up here. These are highly accurate. It's because it's not based on a guess. It's based on real math that the big boys use. Alright? Let's look at a couple of more. Our safest trade is the area between the S2 and the S3. Okay, the big boys almost always make that. The space between the S1 and S2 going down or the R1 R2 going up are very, very difficult areas for the currency to trade out of it. In fact, if you would check your trades, you would find out that probably 60-70% of your losses occur in this S1, S2 area. But once they break, they go out to the S3, and you can see they had no problem going to the S4. Here's another one going the opposite way. Now this is going to be a counter trade. How do I know that? Because this moving average up here tells me the trend is down. That means it's going to have a real hard time making this trade. Okay, so has a hard time getting out of the R1, R2, but it has not much problem. Just kind of crawls up the hill right to the third resistance or the R3, right to it, to the pip. Here's another one going up. Okay, it's the pound dollar. It has a little bit more speed in it, and you can see it was a downtrend right here. So we're going to have trouble until we get out of this moving average, which is the desert area. Once we break out of the desert, we're now trending. Okay, so there's the R2 to the R3, not too much problem, and then they just kind of, once they break the moving average, right up to the R5, and they go right to the pip and stop dead right on it. And remember, you get these in advance. Alright, I like to show this one because this is one where most people get messed up. We can see the moving average is down, therefore the trend is down. Alright, so the market moves down here, doesn't have much problem going from the S2 to the S3, pulses and tries to make the S4, doesn't get it, and pulls totally back. When it pulls all the way back here, you notice that we don't even break this resistance by not even 1 pip. Alright, so that tells us that this move is still underway, and you can see that that's a very, very important point right there. Once it does that, down we go, no problem. So can you see why we stress that staying in until the targets are hit is so critical? It's one of the reasons that most traders fail. They're trading for 5 to 8 pips instead of staying in for the longer runs. So here's the deal. Try us free for 2 weeks. During that time you can test us and learn the setups for free. You can download over 20 training tutorials free. You can trade in our live trading room free. You can take part in a live weekly training classes free. Hope to see you on one of the calls. Always make sure you read the disclaimer because they're very important. Possibility exists when you trade the Forex, as in any other financial trading environment, that you can lose your money, all of it or some of it. And if you have any doubts, you should ask a financial advisor. Thank you.